Hi, everyone. Lots of great questions from various great investments programs users. So I want to go through some of those. So question number one, saw a video of you explaining the possibility of S&P going down by another 10% or more based on standard deviation lines. How do you get those charts? Are they custom made? Well, in terms of charting generally, if you go through the Great Investments Program, you'll see there's a whole bunch of free tools that I list on there. Equally, you've got Yahoo Finance, Google Finance, which will give you lots of charting. I'm not sure if they'll give you the standard deviation stuff. And then there's paid tools like SharePad, for instance, which will give you those kinds of tools as well. So there's a whole variety of things. However, don't put too much weight on a particular tool. Like, just because there's two standard deviations on either side doesn't mean it is the holy grail of 100% certainty. It's just to give you some degree of perspective. And there are other factors that I'd look into that, such as obviously the macroeconomic environment and other momentum indicators I might look at. One of the reasons for the existence of the program is that you've got me supporting you going through it. Okay, and giving you those daily updates, giving you the research that we have, not just from what we conduct, but also what we get our hands on from other big banks and so on. Because we're not a Goldman's or a Morgan Stanley, we can use Morgan Stanley's research and Goldman Sachs's and UBS's and share it all with you. Those banks can't share other banks' research with you. So you've got all those benefits. So that's one thing. Are you looking at any other data to increase your probabilities of predicting the market? Well, as I mentioned, I don't just look at standard deviations and trends. Obviously, I'm aware of the other data that I'm aware of, or the mosaic of data, would be the tons of information which crosses my desk every single day. Everything from news flow to macroeconomic data in terms of Fed minutes to data on projected growth, what other analysts might be saying, what banks are saying. So yes, I do. There's about 1,000 points of data every day. What I do is then summarize what I think is the most important for you to look at and consider. And even more importantly, I tell you what I think is going to happen. Now, if you're trying to reverse engineer that, that's fine. I'd start off with a degree in macroeconomics. That'll help you understand the data. And then after that, I'd go into examining accounting. And that'll help you with the fundamental analysis of the profit and loss accounts, the balance sheets, and so on of the individual companies. And I'd finish off with several books on technical analysis as well, which is another way of me saying, really, do you want to do all of that, or is it just better that I just say that this is where I think it's going, this is the research, this is the output? I mean, if you think about Goldman Sachs Asset Management, let's say, or a Morgan Stanley or a JP Morgan, their wealthy clients are not trying to do it themselves. What they're saying is, okay, give me the exec summary. Tell me what you think, what's worth looking at. Okay, so that's what I'd suggest, but it's taken a lifetime to get to the 1,000 points that I look at and digest them, understand them, and get on with it. So think of it like that. It's very tempting to go down the rabbit hole of, oh, I'll draw lots of lines and this and it, and you'll think, oh, I think I've got the holy grail. There's a lot more to it than that, unfortunately. And you mustn't give too much weight to any particular indicator or any particular signal or any particular piece of information. You've got to know how to weigh each one and what's relevant, what isn't. Most things, as you notice, I don't post on Telegram 50,000 items of information. There's sample information out there. It's because a lot of it, once you've got that knowledge, is knowing what to ignore. That's the most important thing. Let's see. Just would like to see how you regularly analyze the data and what data you look at regularly to see what direction. Yeah, well, there you go. So that's the answer on that one. Got this one from Mitten. Hope you have been keeping well. I cannot complain. I read a YouTube audio thing today which said, just never tell anybody about your problems or your health because they probably don't care. I'm fine in any event. I wanted to say thank you for posting the video regarding shorting oil. No problem. That was the ETF one on the private Telegram channel for Great Investments Program people, as we discussed before, haven't started investing yet. That's fine. And by April, and the reason is, look, me, like many others, are on the sidelines with additional capital and deploying that. Anything that we've sold because 12 months are up, or it's dropped from its peak, got capital, haven't redeployed it yet. I'm not in a mad rush to do so because of the charts that you've already seen that I've shown you, where I still think there's more pullback. Being really interested in shorting oil. If you haven't started investing, that's a pretty tough one to start with, and that's a special situation. It's outside the norms of Great Investments Program. I was really excited when you posted the Loom video. I was thinking about allocating 2K for short SOIL, which is short oil ETF. I was wondering what your thoughts on this are. Well, as I mentioned in there, it's high risk, and what you got to say to yourself is, well, okay, that's fine. What would happen if oil drops 50%? Okay, then what? As in, it goes up another, it goes up from whatever it is, $135 to say $300, and so on. How are you going to feel? And obviously, at some point, it should come back. So with anything, risk capital and timeline. And if your timeline is a year or two, let's hope we can get all back to about $50 and your 2K becomes 4K. That's the idea. But shorting in itself has, look, nothing's guaranteed. Okay, so just, usual risk factors apply. That's what I'd say to that. Right, we've got another one. No, that's all good. That's all good. That's all good. That's all good. Just checking any questions that I might have missed. I think we're okay at the moment. Somebody, I think it was on WhatsApp, and I'm better at email than I am at WhatsApp, only because everybody's gone and moved on to WhatsApp because they think it's quicker. Guess what happens? Everybody thinks the same thing, so emails is the better place. And what I found with the email side of things, I've got another question. I'll come back to that. I think on WhatsApp I had a question about ETFs and energy. How do we make advantage of what's been happening? Well, this whole point of taking advantage of the short term is this. My approach, as you know, the strategic approach is value, growth, income, cash flow, bottom up. The temptation at this time is people say, hey, Alpesh, look what's happening. Let's do something. And the danger is you become gambling at something. Let's dive into whatever. I don't know. Let's go long oil. Let's go long polymetal. It's dropped 90%. Now, if I find those opportunities, I will tell you where I think something has dropped so much that it's overextended and is likely to go back up. The problem with that, with some of the stocks at the moment, is I just think it could drop even further or rise one day, drop another, rise another. What am I supposed to say to you? Hey, buy polymetal. It's dropped 90%, but what if it drops another? What if it's suspended? Oh, it might rise tomorrow. Okay, it's the kind of company where we're going to put anything meaningful in. You're going to put £10,000 in, and then let's say it goes up 50%. You say, great, I made 5,000. Would you stop there? And the next day it drops again, and you've lost it, and then you're confused, and you're watching it constantly. And would you really have put 10,000? No, you probably wouldn't, given the volatility and the risk of losing it. And so you might have put 1,000 in. So for the sake of 1,000, where you might make 500 or lose 1,000, you're going to be spending hours and hours watching it. And it's not economical for me to be doing that. So do you really want to do it? Well, if you do, put it into the Ladbrokes Vegas strategy pot. And that's fine. It's okay to go to Vegas. It's okay to go to Ladbrokes. But make sure you know that's what you're doing, and feel free. But know that that's what you're doing. There's a high likelihood of loss. You have no strategy. You're throwing the dice, and hopefully something will come out of it. And when it does, hopefully it'll work out for you. Because other than that, I've got to come up with a strategic decision on what happens if it drops, what happens if it rises, when do I get out? Investing is like going to war. It's very easy to get into it, but if you ain't got a strategy, bloody difficult getting yourself out of an investment. Okay, so it's a bit like that. Mike has asked me a great question. My portfolio is holding up really well considering, but BP, HSBC is suffering. I've done well with them, but do you think it's now time to get out? Look, the way I decide on anything is twofold. A 12 months up, or is it has it dropped 25% from the peak? Now, in the case of BP and HSBC, neither of those were part of my Great Investments program. They were part of the special strategies, which you would have done a while back. And I think with both, it was give it 3 years, to get to 100% return. Obviously, 3 years aren't up, and this always happens. People go, oh shit, I'm up 30%, but 3 years aren't up, and now the real world is around me. What do I do? So you've got two options. You wait 3 years, or you say, you know what? Think of it like a sliding scale, Mike. Risk averse means you sell all of it because that gives you certainty. What's risk aversion? It is certainty. Risk is the same word as volatility. So it is zero volatility is what risk aversion is. And that means certainty. And that means going straight to cash. So sell all of it. Risk loving means I'm willing to take more uncertainty, means holding all of it. And you say to yourself, where am I on that sliding scale? Where do I feel comfortable? Where do I feel comfortable? It's like a painometer. Just keep turning it until you can't bear the pain. You might say, gets to about 5, you're selling 50%. You think, you know what, that's the right balance between risk and risk aversion. I'll get out now. Could be one of those. Whatever it is, find that balance on those. But yeah, BP, HSBC were special strategies, and hopefully that will help and make sense of it. I've got another one from Sean. Sean, sorry for the delay in replying back to this one. Here we go. I see this stock, which is part of my GIT portfolio, has become subject to a takeover bid, Oxford Instruments. Whilst waiting on the outcome, the current purchase arrangements would see me compensated for my shares by a mixture of cash and shares in the purchaser. Spectra is worth £11.50. The latter part I'm not sure about, as the current price of Spectra shares is £27. I imagine there's a discounted price to make them more attractive, blah, blah, blah. While there is a way to go yet, I'm wondering what you would do with Spectra shares in this case. I'm assuming that they do not meet your value growth criteria at the moment, you would sell them. The takeover bids are difficult because let's say you've got a company and you get a takeover bid, and usually it means, you know, it's popped up 20, 30, 40%. Congratulations, well done, good pick. So for me, that's it, game over. Got it. You'll have to get out because the strategy can no longer apply if it drops 25% of 12 months or up, because you'll either be transferring into another company or just waiting for ages while the price just flatlines, and you know it's going to flatline until the takeover goes through, which usually they do, and the new company is not something you'd thought of. So for me, I just exit and keep life simple. Keeping life simple is really important for me, and it's not just an old age thing. It's just because I've seen it with a lot of investors. They do it. They do it a lot. They complicate things. So hopefully that helps all of you. Thank you all very much. Try and answer another batch soon enough. And keep an eye on the Telegram channel, both the public and the private one, because of what's going on with Russia and Ukraine. I am doing more and more updates, keeping you up to date with what I'm thinking with market directions, any data I'm seeing, because obviously you want more of it. If things were quiet and boring, why would you want to look at, half a dozen Telegram messages a day? Equally, you might be just completely happy with your portfolio and think, I don't need the daily update. Thank you very much for all the research and all the work everybody's doing. I don't actually need it. And that's perfectly fine as well. Okay, thank you very much.